Did you know that dividend investing could be your secret weapon for building wealth? It's true, but many investors are making big mistakes without realizing it. In this video, we'll uncover the most common dividend investing traps that might be costing you money right now. I'll also share a powerful strategy that could change how you invest and set you on the path to financial freedom. Want to take your dividend portfolio to new heights? Let's jump in and learn how to boost your returns and secure your financial future. You might wonder how Sarah, a busy mom with little savings, turned $100 a month into a six-figure dividend portfolio. It's all thanks to dividend reinvestment. Imagine growing your money while you sleep. That's what Sarah did, and you can too. Here's how it works. Sarah invested in solid dividend-paying companies. Instead of taking the cash dividends, she automatically reinvested them. This meant buying more shares with each payout, creating a snowball effect. Let's look at some numbers. Say, Sarah invested in a stock with a 3% dividend yield. In the first year, she'd earned $36 in dividends on her $200 investment. By reinvesting, she'd get about 0.3 more shares if the stock price stayed the same. The next year, she'd earn dividends on 12.3 shares instead of just 12. Over time, Sarah's portfolio grew faster than expected. After 5 years, her initial 1 in 200 could have become over $2,500, assuming a 5% yearly stock price increase. That's a 25% boost without adding extra money. The best part? Sarah didn't have to do anything extra. Once she set up her dividend reinvestment plan, it happened automatically. She could focus on her family and job while her money worked for her. Let's look at a real example. Sarah invested in company XYZ, which paid dividends every 3 months. Instead of getting cash, she got new shares. In the first year, she might have earned 1 new share each quarter, but by year 5, she could be getting 2 or 3 new shares every 3 months just from reinvested dividends. The compounding effect is amazing. After 20 years of putting in $100 a month and reinvesting dividends, Sarah's portfolio grew to over $100,000. That's what happens when you're patient, consistent, and let dividend reinvestment do its thing. Remember, Sarah's success didn't happen overnight. It took time, discipline, and sticking to her plan. But by keeping at it and using dividend reinvestment, she achieved financial success she once thought was out of reach. You're scrolling through stocks when a 15% dividend yield catches your eye. Tempting, right? Hold on. This could be the biggest mistake new dividend investors make, and it might cost you thousands. Sarah, our savvy mom investor, learned this the hard way. Those big yields often hide a dangerous secret. They can be a red flag, showing that a company is in trouble. If a stock's price drops, but the dividend stays the same, the yield goes up. But that doesn't mean it's a good deal. Let's look at some real examples. Remember General Electric? In 2017, its dividend yield hit 4.7%, way higher than usual. Investors thought they were getting a bargain, but GE ended up cutting its dividend by 92% in 2018. On the other hand, Johnson & Johnson has raised its dividend for over 50 years, keeping a smaller but steady yield. Elizabeth E. Evans, a financial planner, explains, if investors think a company can't keep paying its dividend, they'll sell the stock, pushing the price down. We saw this with Frontier Communications in 2017 when its yield jumped to 26% before they stopped paying dividends completely. So, what's the biggest mistake new dividend investors make? It's falling for the yield trap. Don't be fooled by those big double-digit yields. They might look great, but they could blow up your portfolio. Instead of chasing risky high yields, look for companies with smaller but steady dividends. Find businesses with strong finances, steady cash flow, and a history of paying dividends even when times are tough. These are the stocks that can give you reliable income for years. Remember, slow and steady wins in dividend investing. Companies like Procter & Gamble, Coca-Cola, and 3M have raised their dividends for decades, giving investors steady income growth. These are the kinds of stocks that can help build a solid, income-producing portfolio. By avoiding the yield trap and focusing on steady dividends, you're setting yourself up for long-term success. It might not be as exciting as chasing those high yields, but your future self and your bank account will thank you. Imagine getting a fresh dividend payment every month. Sounds great, right? That's exactly what Sarah did by picking stocks with different payment schedules. She created a steady income stream all year round. Here's how Sarah did it. She split her portfolio into 3 groups based on when they pay dividends. Group 1 had companies like Johnson & Johnson and Coca-Cola, paying in January, April, July, and October. Group 2 included Microsoft and Procter & Gamble, covering February, May, August, and November. Group 3 had Walmart and McDonald's, paying in March, June, September, and December. By balancing her investments across these groups, Sarah got money every month. Sarah used dividend calendars to track payment dates. This helped her plan her cash flow and pick stocks that fit her needs. She also used stock screeners to find good dividend-paying stocks with different schedules. These tools made it easier to build a balanced portfolio. Getting regular payments kept Sarah excited about investing. It was like a monthly reward for being smart with her money. After starting this strategy, Sarah's monthly dividend income went up by 15% in the first year. Sarah also added some dividend aristocrats to her mix, like 3M and AT&T. These companies have raised their dividends for at least 25 years straight. They're known for steady cash flows and sharing profits with investors. Adding these reliable stocks helped Sarah boost her average dividend yield to 3.5%. So, how can you build a portfolio that pays you every month? It's all about spreading out your investments and planning carefully. Use tools like dividend calendars and stock screeners, and include some reliable dividend aristocrats. With Sarah's approach, you could earn dividends every month and watch your passive income grow over time. Picture this: the stock market's crashing, your portfolio's turning red, but those bills, they're still there. This is what Sarah faced during the 2020 market crash, but she had a secret weapon: her carefully chosen dividend stocks. While some companies cut dividends, Sarah's portfolio held strong. She'd picked businesses with solid balance sheets and steady cash flows. These stocks kept paying even when the economy tanked. You might ask, how can I protect my dividend income when markets go crazy? Sarah found that certain sectors are like financial fortresses in tough times. Think consumer staples, utilities, and healthcare. These companies keep going no matter what. Let's look at some real examples from the 2020 crash. Procter & Gamble raised its dividend by 6%. Coca-Cola kept its 58-year streak of increases going with a 2.5% hike. Next, Era Energy, a utility company, upped its dividend by 12%, and Johnson & Johnson boosted its payout by 6.3%. Sarah didn't just pick the right sectors, she also chose companies known for staying strong in bad times. During the 2008 crisis, when many companies cut back, Johnson & Johnson actually increased its dividend by 10.9%. Can you protect your dividend income when markets crash? Nothing's guaranteed, but Sarah's approach comes close. Focus on companies with strong finances, steady cash flows, and a history of keeping dividends even in tough times. This can help your portfolio stay strong when others fall. Here's a tip: watch payout ratios. Companies that pay out less than 50% of their profits as dividends often have more room to keep paying when times get tough. For example, Microsoft's low payout ratio let it raise its dividend by 9.8% during the 2020 crash. Remember, good dividend investing isn't just about high yields. It's about finding companies that can keep paying even when markets dive. With the right strategy, you can build a portfolio that gives you steady income no matter what's happening in the market. Here's the refined version of the script. Ever wondered if you could predict which companies will boost their dividends? Sarah found a tool that does just that: the payout ratio. This simple metric shows how much of a company's earnings go to dividends, acting like a crystal ball for dividend growth potential. Companies that pay out less of their earnings often have more room to grow their dividends. Sarah looked for businesses with payout ratios below 50% and strong earnings growth. These companies only use half or less of their earnings for dividends, leaving plenty of room for future increases. Sarah also checked the free cash flow from operations. Companies with strong, steady cash flow are more likely to grow their dividends over time. It's like having a reliable income. The more steady your paycheck, the more confident you can be about spending more. Interestingly, Sarah noticed that companies with a history of increasing dividends, especially those starting with low payout ratios, often do better in the long run. Take Johnson & Johnson and Procter & Gamble, for example. They've raised their dividends for over 50 years straight, starting from low payout ratios early on. Want to spot future dividend growth yourself? Look for companies with payout ratios under 50%. strong earnings growth, and a steady history of dividend increases. For example, a company with a 30% payout ratio that grows earnings by 10% each year could potentially bump up its dividend by 15 to 20% annually while keeping a low payout ratio. Keep in mind, earnings growth is crucial. A company growing earnings at 8% yearly with a 40% payout ratio has more room for dividend growth than one with 2% earnings growth and a 60% payout ratio. Using these tips, Sarah turned her portfolio into a dividend growth machine. She could spot potential before others, giving her an edge in building a portfolio that not only paid well now, but promised even more down the road. You've made it to the end of our dividend investing journey, and what a ride it's been. Sarah's story shows us that anyone can transform their financial future with the right strategies. You don't need a fortune to start. Think about this. What if you could turn $50 a month into a growing dividend portfolio? That's the power of consistent investing and compound growth. Here's how to get started. Pick one solid dividend-paying company like Johnson & Johnson or Procter & Gamble. Check its payout ratio, dividend history, and financial health. Then, set up an automatic monthly investment of $50 through a brokerage app like Robinhood or Fidelity. Your path to dividend success starts now. Picture your portfolio growing over time, getting closer to your financial dreams each month. Sarah's success came from patience and smart choices. You've got this. Are you ready to take that first step towards building your dividend empire?